Hello, everybody. Some old guy with MS again. I just thought I would follow up a little bit on my last video. In the last video, I said, I think if Joe Biden gets in, the markets will crash. And my reasoning was he wants to increase capital gains tax from 21% to 52%. It still is something that would cause a crash. But last night I was thinking a lot of retail investors, like you and me, probably use special accounts that are either tax free or tax payable when you withdraw all the money. So they may actually not be so quick to sell. However, I just saw on YouTube this morning that Jeff Bezos of Amazon sold $3 billion worth of stock. So to me, that makes me think he is thinking taxes on capital gains are going to go up. I better sell some right now. See, $3 billion, if he waited till January 20th, the taxes on that would have been $1.5 billion. Because he did it now, there'll be a quarter. Now, I'm not sure what a quarter of $3 billion is. But $1.5 billion taxes, that is a hell of a lot. See, right now they would be about half of 1.5. I don't know what that is. But considerably less. So it may not be the retail investors who sell, but it may be the big mutual funds, ETFs, and stockholders like Jeff Bezos, like Mark Zuckerberg, because they are potentially facing a huge tax bill. Anyway, like I had said before, I am Canadian, so things affect me a little bit differently. In Canada, the major tax deferring account is an RRSP. And the money you can put in that, I think, is based on your income. The other major tax-free account is a TFSA, which stands for tax-free savings account. And the difference of those two accounts is a RRSP, registered savings. I'm not sure what it stands for. Anyway, with an RRSP, the money you put in it is pre-tax. So when you take it out, you pay tax on it. A TFSA the money you put in it is post-tax. That means you've already paid tax on it. So you put it in a TFSA, and any money you make is not taxed. Well, in theory, anyway. Canada Revenue has sort of modified the rules. If you actually are kind of running a business through your TFSA, they might tax you. But if you're just an average investor like me, it is tax-free. The difference between the way you put money in it is there's a limit set for each year, and it's usually around $5,500. So you can put $5,500 in your TFSA each year. Now, there are some restrictions on taking money out, but they're not near as draconian as with an RRSP. I think with a TFSA, you can take money out, but you have to wait a year before you put it back in, or something like that. You really need to look it up if you intend on making money. I mean, if you intend on putting money in, taking money out, so on and so forth. A lot of people ask me, well, what's the point of either one? You know, I have an RRSP savings account, and I make like less than 1% a year. And the same with a TFSA. You know, that with TFSA savings account. Well, first off, don't get a savings account, because you're correct. It's a complete waste of time. If you get a self-directed RRSP or a self-directed TFSA, you can buy stock. Actually, you can buy stocks, bonds, probably mortgages, all sorts of things. And then you actually can make money. If you have a self-directed TFSA, you can buy Canadian stocks, US stocks. You could probably buy, British stocks. But of course, you're going to have to pay to convert your money to the correct type. In my TFSA, I had lots of Apple stock and lots of oil and gas. So like I've said before, I am completely cash now. I've got cash sitting in my TFSA waiting for the drop, which I do believe is coming. And in my TFSA, I will buy a little bit of Amazon, probably a little bit of Tesla, and a little bit of Apple. And after that, I won't have any money left. But that's okay. Now, if those stocks, say I buy I don't know, let's say I buy $1,000 of each. So I've got $3,000 in the account. If things go as I hope, it should double and I'll have 6,000. But Tesla and Amazon have done way better than double this year. I'm hoping they continue to do so. Apple, I think Apple, it did the worst and it like tripled or something like that. Something else, triple of $9,000. If they do better than that, I'll even have more money. Now, they may not do anything. So $3,000, they may go down, so I could end up losing money. But the thing is this, you don't actually lose money or make money until you sell the stock. So if it goes down, I'll just hang on to it. If it goes up, well, this is another one of the rules that I've changed in my investing strategy. If a stock goes up, I don't sell it until it starts to come down again. Usually, if it drops more than 5%, I start looking at it and thinking about selling it. If it drops more than 10%, sell it, no question. If it drops more than 20%, well, you're a little bit late. You should have already sold it, but definitely sell it now. Yeah. So, like I say, I don't sell stocks until they start to go down. So I may have these for a long, long time, and I may make lots and lots and lots of money. And I may not. I mean, it's more likely I don't. But it's always good to dream. So, yeah. I'm just thinking a bit. I do have like direct trading accounts, and I only really use those when I have to, because I absolutely hate trying to figure out what my capital gain was, what I have to pay in taxes. If you have stock in a straight trading company, if there's ever a dividend, you have to report that in your tax returns. They send you those stupid, whatever they're called. They're not T4s, but T somethings. And you have to report, like, if you got more than, I think it's if you've got more than $5 in dividends, you have to report it. So it's a real pain in the ass. If it's all in a RRSP or a TFSA, you don't have to report anything, period. And that is what I like. So what I'd recommend for everyone, open a TFSA, self-directed account. Now, if you're married make sure your spouse opens one also. Children can't open these until they're 18, but I would recommend your children open one as soon as they're able. RRSPs, well, I've had one for I've had an RRSP for over 30 years. I haven't really made anything in it. Starting to now, but I think when you reach 65, you have to stop contributing. And then I think when you're 70, you got to start withdrawing money. And it turns into a riff or something like that. Yeah. So the idea is you withdraw money. You avoid paying tax when you're at your highest tax rate, in your 30s, 40s, 50s. You withdraw the money when you're retired at a lower tax rate, and you've got additional income when you're living just on your pension. So it's good in theory. I would open an RRSP if I could, if I were you, but I like TFSAs better. The money's more accessible, and it's more like the 5,500 a year you can put in it. You can put that in whether you're working or not. With an RRSP, it is based on your income, so you do need to be working. Anyway, those are the two main vehicles I would use for investing. TFSA is number one. So open a TFSA account if you don't have one. The reason you do it for yourself and your spouse is you get to put 5,500 a year in, and so does your spouse. So together, that is 11,000. It's quite a bit of money a year. Anyway, I think that's just about it. So, communication over. Okay, this is not for you. Start listening. Mouse grid. 8, 8, 1. Click. Mouse grid. 5, 9, 6, 2. Click. Bye.